So hedge accounting. So basically there are some derivative contract, okay, that we enter into with the intention of hedging. That means hedging purpose. Why do we do derivatives? Either for hedging or else for speculation, right? So here we are focusing on hedging. So what do you mean by hedging? Hedging means you are entering into a derivative contract in order to reduce the risk of your actual business or original business. Okay. So now hedging can happen in different forms. Like for example, cash flow hedge. Cash flow hedge means you are reducing the uncertainty of cash. Now, because it is happening over the counter, so when this kind of transaction happens, nobody will publish it on newspaper saying like we have entered into an over the counter derivative, because this is all business as usual for them. So there is no need to publish this kind of transactions. So we will not get to know like exactly this company has done cash flow hedging, this company has done fair value hedging. This way we will not know. Reading the newspaper you will not get this example. Okay, but what sort of situations can make them to do all these things? Like cash flow hedging. Now cash flow hedging means, like we said, interest rate swaps. Certain companies, very lightly you may get information like, let me see in Google, if I'll check if there is any, let's say, Reliance interest rate swaps. Currency swaps at times we get to see because government gets involved in it. No, you see, we are not getting any proper example. We are just getting the explanations of what is interest rate swaps. Even this is not an interest rate swaps. Okay, that is because this is just a part of their normal business, which there is no need for them to uh, inform or publish it over the media. Okay, but then the example that I told you, that in interest rate swaps, how interest rate swaps works, on that basis we have to know that swaps are taking place uh, in order to hedge the cash flow. Like somebody who wants fixed cash, somebody who wants to pay fixed cash, they are hedging it so that finally there is fixed cash flow, and then they are reducing the risk in their business. Like the way I did like this, right? Company X taking loan from your bank. Now this bank says, either go for fixed rate or else floating rate, fixed or floating, and this is 7%. This is market reference rate. Now here, this company's aim is to go for fixed, but however they are going for floating. So this way, after this, they are entering into an interest rate swaps with the investment bank, and overall net, then what happens? Net, they are able to save some percentage, and at the same time they are able to, like, they are agreeing to pay 6% here, and they will get MRR. This way they are receiving MRR and they are paying MRR. So this MRR gets cancelled, and net, okay, net 6% and 7%, net 1%, they are able to gain out of this, because finally they are ending up paying only 6% instead of 7%. Now this is reported as cash flow hedge. Cash flow hedge, or this is termed as cash flow hedge. Okay, so that is a term for cash flow hedging. So this is basically this company is entering into this swaps to hedge the cash flows. Now, which company has done actually like this? That very difficult for us to know, because as I said, it is not published on the newspaper. Okay, this is one thing. Second one is inventory. Inventory is, imagine Kalyan Jewelers. Now, Kalyan Jewelers example company I'm taking here, Kalyan Jewelers, but I will not even get to see Kalyan Jewelers, reporting this on the newspaper. So let me take that example also. Let me check. Kalyan Jewelers swaps agreement for something like gold price. Mhm. These are all the schemes they are offering to the public. But for sure, they are doing all this, but you will not see them reporting anywhere. See, but then every gold company will enter into this kind of swaps. Okay. So Kalyan Jewelers will say, because they want to maintain the price of their inventory. Their inventory is what? Gold. So so yeah. So Kalyan Jewelers and this is gold mining company. So gold mining company. So when they are entering into the agreement, okay, that is called inventory. That is called fair value hedge. Why? They are entering into uh, derivatives inventory. So this one you can connect with forward. Okay, so here they are agreeing to lock the price and then agreeing to get gold at the future date, so to maintain the fair value of inventory. And then same interest rate swaps can also be used as fair value, because they want to reduce the hedge and they want to reduce the volatility. Okay, they want to reduce the volatility of debt. And then net investment is foreign currency forwards or futures can be used to hedge changes in the reported value of the subsidiary's equity. This is say for example Unilever company is there. Now Unilever and Hindustan Unilever, what is the difference? Unilever, Hindustan Unilever, okay, Hindustan Unilever is the subsidiary and Unilever is the parent company. Okay, so this parent company, okay, is an European company, Unilever, and Hindustan Unilever is an Indian one. So now they have done investments in Hindustan Unilever. Now when they, whatever profits they get, their share, when they take it to their country, because of the currency differences, the profit and loss may change highly. So in order to reduce or hedge that, they will also do hedging. So that is foreign currency forward futures. So what is it that done in order to maintain the equities, subsidiaries equities, due to change in the exchange rate? Okay, this topic is there in level 2 actually. CFA level 2 big chapter is there in FSA. But here all you have to understand is, when they are taking their money here, then they will do hedging. Similarly, imagine another example coming to my mind, couple of example, Tata Motors. Now, Tata Motor is an Indian company, but they have you heard about this? I think uh, Land Jaguar, something like this. They have business, right?
Land Rover, Jaguar and Land Rover.
Jaguar and Land Rover.
They have
Yeah,
bought both the companies.
yeah. Land Rover is the spelling right? ROVER. Land Rover. Okay, so Jaguar and Land Rover. These are UK, you know, products that they sell in UK. So they are making revenue in UK, right? So obviously, when they bring it to India, the exchange rate will, can bring a lot of changes here. So they tend to hedge that. So that will fall under net investments hedge. Okay. Then,
Yes, I understood.
yeah. Similarly, another example, Airtel. Now, Airtel has business apart from India in another country also, Africa. So they provide SIM cards and this. They have this SIM card. I don't know, but they have this tower. This telecom tower. All those in Africa as well, and their business is huge over there in Africa. So they are generating revenue from Africa. When they are generating revenue from Africa and they bring it to Airtel India, now currency fluctuations can reduce the earnings. So when they hedge this all will come under net investments hedge, because these are all the investments they have done, huge investments they have done, right, in another country. All these are examples. So all these are companies name also I'm giving you, but I cannot prove it taking some news articles. Okay. Probably somewhere annual report, or maybe somewhere it is mentioned possible in the annual report. Okay, fine. Okay, any other doubts?
No, sir.
Okay, so we were speaking about this continuous compounding, right? No arbitrage price with continuous compounding. Yeah. So now before doing this, let's say uh, let's say uh, this is the timeline: 0, 0.5 and 1 year. Okay. Um, Imagine you are expecting a dividend of uh, let's say 5 rupees dividend. Okay, just 1 minute. Let's say spot price is equal to 100. Risk-free rate is equal to 15 percentage. Okay, 15 percentage per annum. Expiry is in 6 months. Okay. So now the question is, what should be the forward price? What should be the forward price? Okay. So how do we calculate? This is 6 months. So normally what we will do is, this is 100. So it is 6 months. No? So 1 plus risk-free 15 percentage raised to 6 by 12. That means 0.5. Okay. Just calculate this, how much it comes to.
107.2380.
Yeah. Its forward price will be
So
107.
we can also like do it like 1 plus 7.5%.
1 plus 7.5 percentage.
Yeah. Then we won't have to put like reach to anything. Okay.
No, that will not be the right one.
Okay.
Okay. If you do 1.7.5 percentage, check how much are you getting now. Some differences will come, decimal differences.
It's like 107.5.
So that is wrong, no?
Yes, like this. 0.30
Yeah.
difference.
Okay. Now I'll extend this question further. Suppose uh, let's say after 2 months, spot is equal to 120. Okay. So what is the uh, value? Value means profit and loss. Okay. Profit and loss at time 2. Time 2 means after 2 months. After 2 months. So how will I do? See, again 6 months. It was 100 initially. Now after 2 months, it has already reached 120. Okay. But we agreed for 107.23. So after 2 months, I'm standing here and spot price is 120. So if I have entered as a buyer, will I be happy or not? Anything above 107.23, I will be happy if I have entered as a buyer and I have agreed for this amount, 107.23. And the price has already reached to 120. So I will be very happy. Let's see how much profit am I making out of it. So because I'm standing at time 2, I have to bring everything to time 2.
So
Everything as in,
2 by 12, right?
yeah, this one, see, not 2 by 12. See, I have to bring it over here. Okay, today what would be the price of this 107? Okay, like for example, if you are buying a home for 10 lakhs, let's say, before 10 years you bought, imagine, and then today you are saying the price has reached to 50 lakhs, I have got 40 lakhs profit. You cannot say 40 lakhs profit. You have to bring it, maybe you have to adjust with inflation, and then you will know that this 10 lakh has become 30 lakhs, and then 20 lakh is your actual profit. Correct. Similarly, so you have to bring that 10 lakh to
So
today's
like
time.
divided by 1 plus 15% raised to 4.
Similarly, you have to bring it here. You have to take it backward. So because we are taking it backward, we will discount it. So discounted at 1 plus risk-free rate is how much? 15 percentage, correct? So 15 percentage raised to 4 by 12. Just calculate this amount. So when you do like this 4 by 12, it will push the price 4 months back. Calculate. So how to calculate? First you calculate 4 by 12 and keep it in store 1. Then you calculate this 15 percentage plus 1. Then raise to 4 by 12. So separately you calculate and store it. That is fine.
$102.349.
102.349. $102.349. Okay. So how to do? I'll just show it to you once. See. So 4 by 12. So 4 divided by 12 equal to 0.33. So I'll keep this as store 9. Is it 3 by 12 I took or 4 by 12? First I'll change the decimal.
4 by 12.
4 divided by 12. So I'll keep it in store 9. Just then 15 percentage plus 1. 15 percentage plus 1 equal to. Okay, then raise to recall 9. Okay, because I stored in memory or store 9 equal to. So I have solved the denominator. Inverse into 107.23. 107.23. So 102.34. Yeah, correct. 102.34. So it should be 102.34, but already it has reached to 120. So take the difference. That difference is my profit.
It's 17.651.
So 17.65 is my profit right now. Right now means what? At time 2. At time 2. Is it okay? Fine. Okay. Understood this one?
Yes, sir.
Okay. Now one more example. Another one. Let's say spot is equal to 2000. Expected dividend in 2 months. Okay, dividend is expected in 2 months, 50. Then expected dividend in 7 months, or only 2 months is enough. risk-free rate is 10% per annum. Okay. So first question, what is the forward price for 1 year? Second one, after 3 months, spot is equal to 2500. What is the value? Value means profit or loss. If you are the buyer. If you are long, long means buyer. Okay. So first you draw the timeline, 1 year. And spot is 2000. And after 2 months, this is 2 months. Okay. This is 12th month then. After 2 months, 50 you are expecting. So what is the forward price? So now how will I do? See, normally if this wouldn't have been there, then how I would have done? 2000 into 1 plus 10% raised to 1. So 2200, correct? Okay. 2200. So now, because this dividend is also involved in it, then what will I do? Now, what I should do, see, right now, it is 2000. So that it is 2000 because people are expecting dividend 50 rupees in 2 months. Okay. So, but by the time I calculate the forward price and come over here to the 12th month, in the second month itself, its effect is gone. Okay, in the second month itself, its effect is gone. So that means this 2000 is not a pure value. Okay, this 2000 consists of the effect of 2000 as well. So it is kind of a rigged value. Okay, not a pure value, this 2000. So what I need to do is, even if I say this is 2000 into 1 plus 10% equal to 2200, then because I have already taken the rigged value, this 50s is also a part of 2000, I will calculate its, because while dragging this number 2000 here, I have kind of dragged this 50 also here. So this 50, 1 plus 10% for 10 month, just calculate how much it comes to for 10 month, compound it.
$54.13.
Okay, so 54.13 has been dragged. So what should I do? I should reduce that amount, because once I cross 12th second month, its effect is supposed to go away, but I have dragged it till the 12th month. So I'm supposed to reduce this 54.13.
Like you're reinvesting that 50 rupees of dividend, right? $50.
Acha, after 3 months, spot is 2000. We are investing. Sorry, what did you say?
The 50 rupees ka dividend which we got, like we're reinvesting it.
No,
That's
no,
why,
no,
like,
no, no. We are not reinvesting. Here it looks like we are reinvesting. Correct.
yeah.
Actually, we are not reinvesting. That's why we should minus it.
From the final price.
Yeah. How much? How much is it? Can you hear me? Hello?
Yes, sir.
2200 minus 54.13.
Minus. Yeah, it's 2145.87.
Okay, so this is the forward price. I can do it in another way also. See.
So what about the third month? Like you gave some information, right?
Right now I'm standing here only. After 3 months, what happened that we will see little later. Okay.
Okay.
So another way to do this is 2000 and second month it is 50 rupees. So I know that it is this 2000 is not very pure. So I am calculating what is the present value of 50. So present value of 50 is 50 divided by 1 plus 10 percentage raised to, this is 2 months away. So 2 by 10, 12. So just calculate this one, 2 by 12.
It's 49.2120.
49.2120.
2120.
So this amount we are going to reduce and calculate now. 2000 minus 49.2120.
It's 1950.788.
1950.788.
788.
This is the pure amount. Okay, without the effect of 50. Now you compound this for 12 months. 12 months means 1 year raised to 1.
Yeah, it's 2145.8668. It's raised to 1, right? Like,
Raised to 1. Now you
yeah,
see it is matching.
yeah, it is.
So whichever you feel easy, you may do as per whichever way your mind is able to imagine that. Is it okay?
Just a minute, so I'll take it.
You want to write down?
No, I'll just see it once.
Shravani, have you understood this one?
Yes, sir.
The second one is easier, right?
Okay, you follow second one. Whichever
Second one. Like we're first discounting the dividend, deducting it from the present value, and then multiplying it to the risk-free rate, right?
Yeah, compounding with the risk-free rate.
Yes, sir.
Okay. Then so this is the forward price 2145. This is the one answer. Then after 3 months, so now it is fine. We know that forward price is 2145.868. After 3 months, it reached to 2500. Now you bring it here so that you can compare. So 2145.868 divided by 1 plus 10 percentage raised to 10 by 12, because it is not 10, 9 by 12, because it is 9 months gap. Calculate now.
It's 1997.8286. 0.8286.
So difference is the profit.
Okay, plus 502.171.
Fine. Okay. Now the point that you are supposed to understand here is there was a dividend in between, and that dividend has been reduced, taking the time value of that dividend, and we have reduced it. Is it okay?
Yes, sir.
Okay. Now we'll come to the sum. You see here it says 1550, but continuous compounding. Spot is 1550, but continuous compounding. So 1550, this is the present value, into e raised to rt is the formula. E raised to r is 10 percentage. Normally this is how we would have done. For how many months? 6 months. So it is 6 by 12. Okay, so just calculate this one. You know now how to calculate this. So 1550 into e raised to 10 percentage into 0.5, right? So so 0.5 into 10 percentage. So 0.5 into
0.05.
10 percentage, okay, equal to
0.05.
it, right? Wait. Second format 8, enter. 10 percentage into 0.5. So 0.05. Now E is over here. Okay, above ln. So I'll do second and ln to activate the upper function. So that means 1 will reach to 1.051. So multiplied by, so how much will 1550 reach to? So multiplied by
1629.471. 470.
Yeah, 1629.47. So 1629.47. Okay. Okay. 1629.47. Okay. Now the question is changing here. The question says there is a dividend yield also in between. So some dividends also they are getting. Now continuous compounded. Okay. So because it is continuously compounded, now can you understand that we are supposed to reduce that just like we are reducing the amount here? So what will I do here? 1550 into e raised to 10 percentage. From this percentage, I am going to reduce. Acha, this is not 10. Risk free is 3 percentage. Oh, I took 10 percentage here by mistake. You people did not tell me also. This is 3 percentage. 1550 into e raised to 3 percentage into 6 by 12. Just calculate again.
So it's 1573.425.
1573.425.
425.
Okay. Now this should be the forward price if this dividend yield is not there, but then dividend yield is also there.
Yeah.
So now we know that because dividend is also there, we are supposed to do that adjustments the way we did before for dividend. We reduced dividend. So here we reduced dividend amount from the amount, but because here rate is given, we reduce it from the rate. So
Okay.
1550 into e raised to 3 percentage minus 1.3
1.3.
percentage. Okay,
It's
into
1.7%.
6 by 12. Okay, now you calculate. So it will be 1550 into e raised to 3 minus 1.3 is what? 3
Yeah.
minus 1.3
It's
is
one.
1.7 percentage. Okay.
Right.
See, now when you are adding or subtracting percentages like this, ignore percent and then you add or
Yeah.
subtract. That means
Yeah.
3 minus 1.7 and then suffix with percentage. Okay. Into 0.5.
Yeah. It's 1563.2311.
156.
3.2311. Yeah.
Okay. So this is it. Fine, understood why we are reducing, because this amount is influenced. Okay, so we have to reduce this. Okay, this amount is influenced by that dividend yield spot, but by the time we cross after 6 months when we come, this dividend yield effect would have gone, so we are supposed to reduce that. Okay, the next one, forward contract on currencies. So forward contract on currencies. Now suddenly they have included currencies here. See, this P/B means price currency to base currency. Now if I say 85 rupees is $1, okay, this denominator currency is always called as the base currency. Any currency that is mentioned in the denominator is considered as the base currency, and any currency mentioned in the numerator is called as the price currency. Okay, price currency. Right, price currency and base currency. Okay. Now suppose if this is the case, now $1 is 85 rupees, and I want to know what should be the exchange rate after 1 year. So just like normal formula, present future value is equal to present value into 1 plus r raised to n. over here also. Now but this R will be the interest rate here, because it is India's interest rates will come. Let's say India's interest rate is 10 percentage, and then denominator also there is a currency. So this is US currency, so US's interest rates will come. Let's say here the interest rate is now 5 percentage, so 5 percentage will come. Now you calculate this. First you calculate this one, 1.10 divided by 1.05, then into 85. Just calculate how much it comes to.
Is 89.0476.
89.0476 rupee for $1. This will be the expectation. Okay, this is how we are supposed to calculate forward exchange rate. Forward exchange
Forward
rate.
exchange rate.
Yeah, how will you calculate forward exchange rate?
So
Okay,
what are these interests like? 1 plus 10%. Like rupee is appreciating by 10%.
this is the this is the this is the inflation. You can say inflation rate, or you can even say interest rate. Okay,
Okay.
they said interest rate here, so we'll stick to interest rate then. Inflation also is correct only. Let's say interest rate. Is it okay?
Yes, sir.
Okay. This part is called carry trade. Okay, so I'll just explain with a simple example. Later on that basis, you can try this at home also. Okay, see, uh, carry trade. Carry trade basically means borrowing from the country of lower interest rates and investing in the country of higher interest rates. Okay, borrowing from the country of lower interest rates. Say for example, in US the interest rate is 5 percentage, and in India the interest rate is 10 percentage. So now uh, let me take this as 2 percentage. Okay, in US it is 2 percentage. So you are thinking that I will borrow from US and I will invest in India. Let's see how it works. So you borrow $100. Let's say $1 is equal to 85 rupees right now, currently. So when you borrow $100 and you bring that to India, that will become how much? $1 is 85 rupees and $100 is equal to 8,500. Okay, 8,500. Then you are investing and you are going to get 10 percentage. You invested into some bond, you will get 10 percentage. So overall, how much you will have after 1 year? 8,500 plus 10 percentage. Calculate.
9,350.
9,350. Now this 9,350 rupees, you will take it back to US. Okay, so when you will take it back to US, that time obviously the exchange rate would have got changed. So let's see in different scenario how it works. So let's say by that time it became 95. Just I'm exaggerating so very highly so that you can understand the difference. From 85 it became 95. So how much will be 9350 be? So 9350 divided by 95, right?
So it's 98.4210.
98.4210.
Yeah.
You have to pay $102 to the bank because 2% is the interest rate you have borrowed for. So you have to pay 102. So net, what is it for you? Net, it's a loss. Correct? Net is a loss.
Yes.
Even though you made profit in India, when you took it to US, you are incurring losses because of the exchange rate fluctuations. Okay. So now suppose if the exchange rate, you know, fluctuations means what now? Currency has become weaker. Okay. That's why $1 is 95. If this would have become stronger, imagine.
Let's
So
say if it was 80,
yeah, so let's see that now.
so like 935 by 80.
So $1 is equal to 80. Then what would have happened?
So it's 116.875.
9350 divided by 80.
80, yeah.
1
6.875.
Yeah. So you have to pay 102.
Yeah,
So
so
remaining is your profit.
yes, so 14.875.
14.875 is your profit.
So,
Okay, see, if wherever they are investing, if that country's currency becomes stronger, they are able to make more profits. Otherwise, they are making losses. Okay, this is called carry trade, borrowing from the country of lower interest and investing in the country of higher interest. Okay, carry trade. Now, the same thing only they have given some other countries example. Okay, I'll quickly do that one as well so that it becomes easier for you. See, consider a situation at time zero where the risk-free rate in euro is 3% and the risk-free rate in US dollar is 2. The current exchange rate is okay. So current exchange rate is 1 euro is $1.10. So 1 euro $1.10, and interest rate in US is lower, so US 2%, and in euro it is 3%. And the current exchange rate is 1.1. We will examine the arbitrage transaction that establish this relationship by looking at the trades for the investor based in US that seeks to profit from the higher interest rates on euro. The investor borrows $100 for 1 year at two interest rates. Okay, so borrow $100. Then what will you do? You will bring it to euro. In euro, this is the exchange rate. 1 euro is equal to 1.10. So for $100, how much will you get? Just
90
calculate.
point, 90.909. So 90.91.
90.91 euro you are going to get, and you will invest and you will get 3%. So
Yeah.
now how much will you get?
So it's 93.63.
And then this is euro. You will bring it to US.
Yeah.
So 93.6364. 64.
Yeah, it will be six. Yeah, it was 636. So, sorry.
So 64. Let me take book number only.
Okay.
Okay.
93.64.
Now suppose they are saying if no movement takes place, if this exchange rate is as it is, then what will happen? Suppose if no movement, even here, suppose if no movement happens, $1 is 85 only, then what would have happened? So
We'll earn profit, right?
no, see, $1 is equal to 85, 9350. Just check 9350. You will not make any profit or loss. Check.
It's 110.
It is coming to 110.
Yeah.
Acha, sorry. Yeah,
So,
yeah.
but still we are making eight
Yeah,
because
yeah,
of the
yeah. No,
interest
it's a
rate, right?
profit. Yeah, yeah. Staying there like that
Yeah.
only is good only. Yeah, yeah. Right. Sorry.
Because of the interest rate is high.
You'll still make
So
profit. Yeah.
8%
If it doesn't, yeah, if
8%.
it doesn't depreciate, you will still make profit only. Yeah. Okay. So here in this case, 93.60. Okay. If the exchange rate at the end of the year is 96 point, so it's fine only. Yeah. They are also making profit. Yeah. So one euro is equal to 1.10 euro dollar. So 93.64 euro is how many dollar? Just multiply now these two.
It's 103.004.
103.004. You will repay 102. Correct? 102 you have to pay. So
Yeah, it's
1.004.
1.004. Yeah. Still limit profit.
Okay. So 1.0. Ah, okay. You will make this much of profit. Now suppose they are saying like at what rate you will not make neither profit nor loss. That will be what rate? So that will be uh, that will be 102 divided by 102 divided by 93.64. Just calculate this. 102 is what you are supposed to pay. So imagine you are paying all to them. So at what rate? Just
One
calculate.
point. Just a minute, sir.
0.
64. Right? Yeah, 1.0892.
1.0892. 1.0892. Okay, so 1.0892. So if the exchange rate would have been, this is euro, so this is euro. So if $1 is equal to 1.0892, then what would have happened? 93.64. So it will be 93.64 divided by 1.0892.
85.9713.
No. I think some mistake I have done. Wait. Is this dollar? Uh, 1.10. 102 divided by 93. 0.64, 1.0892. €1 is 1.0892 dollar. Yeah. Then 193.64 euro will be how much? Now you multiply these two. Yeah, right. It's coming to 102, correct? $102. Hello? Hello?
Yes, sir. Hello.
Yeah. Understood this one? If
Yes, sir.
if the exchange rate would have been 1.0892 dollar, 1 euro. Okay, here 1 euro is 1.10. From 1.10, if it comes to 1.0892, then it would have come to 108 only, and that 108 they would have paid to the bank, and so no profit, no loss. So no profit,
So you multiplied 93.64 into 1.0892.
profit,
Right?
no loss. Huh?
We multiplied 93.64 into like
1.0892.
1.089.
Yeah. Okay. Because this is equal to sign, na? So this many dollar. Numerator is dollar. So 1.0892 dollar I will get. Okay. This is dollar for 1 euro. For 1 euro. This is fine now. So this is what they have all given here. So there is no arbitrage at 1.0893 or 1.0892. That is okay. Then different exchange rate they have given, saying like, yeah, here you will make profit, here you will make losses. Basically, if wherever you are investing, if that country's currency becomes stronger, then the investor will be happy. Like for example, if when FII investments happens, foreign institutional investment happens in India, they want India to do better in their GDP. Then only Indian currency will become stronger, and then when they take that money to back to their country, they will make profit. Okay, this is called carry trade. Carry trade. Now, it is not a foolproof method to say that you have to borrow from the lower from the country with lower interest rate and invest in the country with higher interest rates. Generally, this is the rule. Okay, but ideally, you want to invest in a country where which will become stronger, whose currency will become stronger. Ideally, okay. So that also we should factor in. But here, just we are beginning now. It is okay to have the rule that borrow from the country of lower interest rate and invest into the country of higher interest rate. But in website you will get certain questions where it will happen vice versa. That means from the country of higher interest rates you are borrowing and investing into the country of lower interest rate. Why so? Because that lower interest rate country tends to perform better than the higher interest rate country. So in that case you have to do accordingly. Okay, but in this case we are assuming that higher interest rate countries are doing better. So borrow from lower interest rate country and invest in higher interest rate country. Fine, okay.
Yes, sir.
This is not required as such. This nobody is going to ask you. We have already done forward exchange rate. That much, if you stick to it, is fine. Okay, fine. So we will now stop here. So next time we will begin from reading 70. Okay, let's stop now.
Yes.
Okay, yeah.
Thank you, sir. Bye.
Thank you, sir.